Hi everyone, welcome again to another financial analysis video. I'm Moeed Amin and I'm here with my colleague Ted Wainman. Today we have a British infrastructure and energy group business to analyze for you, company by the name of Esken. So they're a business where kind of two of the core holdings that they have are in London Southend Airport, and another company called Stobart Energy. Now, Stobart Energy basically take waste wood from, say, the construction industry, and they turn it into energy. So Esken is a group business that focuses on aviation and energy, and two of its core assets are those two businesses that I just described. So we're going to look into that group finances. Now, this particular company was a request from, say, a couple of people, actually, right, Ted?
That's right, absolutely. Here they are.
Excellent. So TPD Investing, and we also got one from RS Fourth Win. So thank you both for your request. Here is your video. And before we go into the finances, a couple of things to note here. First one, don't forget to like, share, subscribe, because that will give you the instant kind of notification of when we post our next videos, and we're posting them at a rapid rate on a weekly basis. So don't forget to like, share, and definitely subscribe. And also, if you have a company that you would like us to analyze for you, whether it's for your investment thesis or whether you're thinking about doing business with them and you want to learn more about these businesses, do leave a note in the comment section. I would say about 98 or 99% of the companies that we have been analyzing for the last 2 or 3 months have come from you, our viewers, right, and our fans. So your voices will be heard, and we will do those analyses for you. Now, before we go into this analysis, one important point to remember, which we mention in most of our videos, but it's worth mentioning again. We are only looking at the fundamental financial analysis. It is a snapshot of a current period in time for when that financial report was published. This is not about giving you one video that will tell you everything you need to know about this business for your investment thesis or whether you want to do business with them. We encourage you to look at all the other areas that are going to be important, such as industry knowledge, looking at their contracts and their customer concentration, if there are any risks there. Look at the executives of the business, right? Talk to their suppliers maybe, right? So there are a lot of things that you should be doing to make sure that you're comfortable about the investments. But for this video, all we're doing is the fundamental financial analysis, which is still very important, and a lot of people do struggle with it. So this is why we're doing these videos and why they're so popular. So Ted, I think that's sufficiently teed up. What have we got to share about this business? There's quite a few things, right?
There is, Moeed. So this has been, I have to admit, this is quite an interesting one, and I'm wondering how much I can actually cover in the kind of 10 or 15 minutes that we have. So Esken, as you mentioned, they are Southend Airport and this kind of this renewable energy. And their accounts very easy to find. They're on their website, and you'll notice that on the screen now we're scrolling through the accounts, and lots of information about what they do and where they do it. Lots of really pretty pictures and glossy reports, and all about the board of directors and how wonderful they are, etc., etc., etc. And it kind of goes on and on and on, and how much they're getting paid, and their kind of corporate governance and the checks and balances. And if you are going to be doing your fundamental analysis, you should really be reading all of this information. But what we're going to do is jump straight down to the numbers. And here we go. We're on page 111. To look at the, oh no, we're not, we're going to page 110 to the income statement. And so here is the income statement. So up at the top line, we see the revenue for this company. So here is the revenue. And the first thing we notice is we're dealing with from year ended February 2020 to the year ended February 2021. So pretty recent set of accounts, and their revenue has fallen by 22%. Okay, so that is certainly not good, but you'd kind of expect that, certainly if you're going to be running an airport with COVID, if the airport's closed, then your revenue is going to go down significantly. What we also notice is that there's no cost of sales. So this is a fixed cost business. And so what they do is that they just lump all of their sort of sales, general, administrative into this line here, which is the kind of the costs of running all of their facilities. And those costs have also dropped very slightly. But they also see, unfortunately, that if you're making revenue of 110 and it costs you 134 to actually deliver that revenue, you're going to be making a loss. And there is the loss of 17 million pounds compared with 6 million pounds the previous period. Okay, now this is a company that's been affected by COVID. However, this figure here was nothing to do with COVID. If you remember, it kind of kicked in really in about, pretty much in March 2020, and therefore, fundamentally, this company is making a loss. This loss is stated before depreciation. So we then have depreciation of the assets. They made a loss on acquisition of a company, so they've sort of written down an acquisition, and they've also got some impairment of other assets. You'll notice that this impairment is going on a regular basis, and so the operating loss, the fundamental operating loss of the business, is 130 million, which is very similar to the previous year of about 127 million. We then notice that this company has got lots of debt sitting on the balance sheet because it's paying a lot of interest, 17 million, and that's very comparable to the previous year. There's an impairment of a loan note here. That's a pretty significant amount, and we probably want to go and have a look at note 11 to find out about that. And we'll go and have a look at that in a minute. But I can tell you that that is effectively, they've lent money to one of their subsidiary companies, 8 million, and they've decided to write that amount off and say, we're never going to get it back again. Anyway, the kind of the bottom line is the continued the loss from continued operations, 143 million. Unfortunately, that's not the full story, because we need to scroll down a little bit further. We see some loss from discontinued operations, leading to a total loss for the year of 155 million. Okay, compared with 138 million the previous year. So quite a lot going on there. The key points are that, they're operating at a loss. They've had to write off a loan to a subsidiary. They are paying interest that they can't afford, and they have loss-making parts of the business which they're effectively trying to offload and get rid of. And this is a fairly consistent story year on year. So it's not looking particularly rosy from their profit and loss account, especially as the underlying business does not appear to be generating the profit that they require, especially, and don't forget that that's actually even before depreciation. So let's just have a look at that note 11 while we're here. We should, the big numbers, we should generally sort of quickly go and have a look at those notes. So note 11 is actually on page 131. Here it is, and we see the loan note down here. So this paragraph down here is talking about the loan note, and we see, in addition, there's an impairment charge of 8 million in relation to a shareholder loan note relating to Mersey Bioenergy Holdings Limited. Okay, and effectively, they had future discounted cash flows deteriorated, and so they've effectively waiting refinancing, and so that they've just written off that loan to that investment company. So it's a company which is part owned by this company, and they just written off. They had some debt in there, and they've actually effectively just written that off. So let's go and take a look at the balance sheet. And here is their balance sheet. So top of the balance sheet, we see the non-current assets. These are the things that we need to run our business. You'll see that there's been a slight decrease in those numbers. Don't forget, there's depreciation is going to be a part of that, but also they have been offloading some of their parts of the business that they don't want. You remember that loss from discontinued operations. So we would usually expect to see, a subsequent sort of reduction in the size of the balance sheet accordingly, and that's probably coming through there and note 15 will give us a little bit more information if we wanted to go and have a look at it. Here are the current assets, so the things that we own that we are either cash or trying to become cash quite soon. And we notice that they've got about 12 million of cash on the balance sheet, and the rest is inventory and trade receivables. Scrolling down to the bottom half of the balance sheet to look at the liabilities. The current liabilities are 204 million pounds. Okay, 204 million pounds current liabilities compared with current assets of 55 million. This means that liquidity is a major issue. Now, we need to pick this apart. We notice here that there are some loans and borrowings which are due quite soon, and also some exchangeable bonds. More information is given about those on note 25, but effectively these are effectively loans which are falling due quite soon, about 140 million. We'd expect the company to refinance that, and if they can refinance that, then it just means that the trade and other payables is comparable with our current assets, and liquidity isn't looking so bad. It's pretty close, but it does depend on this company's ability to refinance its debt. You'll notice on the non-current liabilities, the long term, there's lots of long-term debt sitting up here. So let's just clear those and look at that in detail. So here is the short-term debt. Here is the long-term debt. The short-term debt, don't forget, is merely the short-term portion of the long-term debt. A little bit like if you have a mortgage, most of your mortgage you have to pay next year, the year after, and the year after, but some of it you have to repay next month and the month after, the month after that. So the stuff you have to pay within 12 months is classified as short-term. This is expected to be refinanced and go into here, but what we do notice is that these are still pretty big numbers. It may have come down, but these are pretty big numbers, and that drives the interest that they're paying. If you remember on the profit and loss account we looked at, the interest cost is 16% of their sales revenue, so it's expensive. And they can't afford it because they are operating at a loss. So this has got red warning flags starting to pop up all over it in terms of liquidity, too much debt, weighing it down, can't afford the interest payments. Right at the bottom, we've got the capital and reserves, and we see, this is the amount that's been invested by the shareholders. That's about, what, 450 million pounds. Of which they've managed to lose so far 401 million pounds, and what we're hoping is that they're going to turn this business around. The balance sheet has gone from 100 million positive to 50 million positive, and it is shrinking. So lots of red flags all over this. So I quite like to know whether the auditors have picked this up. Obviously, we expect that they have picked it up, but let's have a look at page 105. And on page 105, we will find the auditor's report. And here it is on the auditor's report. We see going concern. So they've given us a note on the going concern, and it says, the auditors, we draw attention to note 1 of the financial statements, which describes material uncertainty in respect of securing the necessary funds from the banks, and the banks not recalling any of their money, and their ability to basically raise more capital. That's basically what they're saying. So they're saying, can we refinance the loans? Can we raise more capital? Will the banks pull the rug from underneath us? And if they do any of those, then this company may not be around in 12 months' times. So these matters constitute a material uncertainty. So this is the auditors, if you remember, and they are referring to note 1 in the financial statements, because the financial statements are prepared by the directors. So we'll just look at note 1 to see what it actually looks like. Here it is on page 115, and the first note here is going concern. Here it is, and all of this talks about the business and its ability to refinance and effectively to stay alive. So I would strongly advise any potential investor to read through that section in great detail, and make sure that they are fully comfortable, that they are happy that this company is going to be around in a year's time or 2 years' time. So let's just go to the cash flow, finish this one off. Here's the cash flow, and we see that the cash flow, so they are generating negative cash flow. So you remember they've only got about, what was it, about, I can't remember how much cash in the bank, about 12 million, something like that. And they're burning at 28 million cash flow, which means that, they haven't got enough money to see the year out. So they're going to have to do something they're going to have to raise more money. Not only are they going to have to refinance existing debt, they're going to have to raise more money in order to generate to generate the cash in order to survive. What else do we see on the cash flow? Well, oops, let's clear those annotations. So a little bit more on the cash flow. So you can see that they've got positive cash flow from investing activities. This means that they are divesting, and here we see the sale of investment property. So they are disposing of, and this is kind of like selling the family silver. You can only sell it once you've sold it, and you've used that money up, it's gone. You can't sell it again, obviously. So they are, they're selling off a property, investment property. They're selling parts of the business, especially those parts of the business which are not profitable. So that doesn't look too healthy. Remember, look, the previous year there was actually an investment going on. There is a bit of investment going on at the top. This 3 million up at the top, and then the investing, so the financing activities. So what we see here is the issue of shares. So they raised shares during the year, 91 million pounds they raised, and effectively they've burnt through that. They've used it to to pay down lease payments and to kind of pay off loans, for example, and repayment of other borrowings. So a lot of that, it's a positive number, net positive number. Here we go. There's the cash at the end of the year. So 12 million of cash. They're burning at about 25 to 30 million a year. They're going to have to do some more fundraising. Are the investors going to be open to that? Are they going to be continue to put their money behind it? Well, you're going to have to dig into the story that they are telling you. I look at this business and I think they're operating a a renewable energy in an airport. I really struggle to see the the synergies there. This is kind of part of the Stobart group. So there's there's lots of lots of stuff going on in this company. It doesn't sound to me like they've really got a grip of actually the fundamentals. I can't see the the natural synergies between an airport and a renewable energy company. It looks to me like it's more speculative than really somebody who knows what they're doing, sticking to their knitting, and producing a good set of accounts. So there's a lot going on. We've kind of run out of time. I mean, we could analyze these accounts. We could go into the numbers in much more detail, and I'm sure that we'll get some comments of people saying, oh, you missed this and you missed that, and what about this? We just don't have time. But on the face of it, Moeed, this is looking, put it this way, it's not really appealing to me. Let's say that. So let's look at the share price, and here is the share price bouncing all over the place, and we see up in 2000 and what's that, 2017, 18, it went all the way up, and since it has been on a steady slide down, and there it is today. It's valued at 135 million. Remember, there's a balance sheet value is about 50 million, so 135, 50 million. There's a little bit of premium in there, a little bit of inherent goodwill, not a huge amount, but then I wouldn't put a big rate on this. It's valued at 1x sales, but those sales are it's operating at a loss. I'm not really overly convinced by this business. If truth be told, Moeed, for me, I don't have the stomach for it. But quite an interesting company, and hopefully gives you a sense of, you know, the numbers. When you've got numbers flying around like that, you kind of scratch your head. Either these guys are really starting to get on top of it, and they're clearing out some of the old deadwood, and they're going to have it, you know, it's going to look messy for a year or so, but then it's going to come good, or it's scrabbling and it's struggling. It's got a ton of debt. It's a millstone around its neck, and it's a bit like a drowning man. And the best thing to do is to put them out of their misery.
There you have it. There you have it, right? So what are everyone else's thoughts, right? So if you have any insight about this business, leave a note in the comment section, and always like, share, subscribe. And, you know, if you want us to look at another company in this sector, then do leave a note in the comment section. But there you have it around Esken, right? What are your thoughts? So till the next video, thank you, everyone. Thank you, Ted. And we'll see you in the next video where we will analyze another company.
Good to see you, Moeed.